Investors in enterprise security giant Palo Alto Networks have felt anything but secure since the stock hit a 52-week high of $80.84 on March 18th. Since that peak, the stock has been down by close to 30%, hitting an intraday low 2 weeks ago of $57.47. But they wouldn't stay down there for long, rebounding by more than 15%, closing Friday at $66.99. Shares are up 16% year to date, but the share price gyrations are just some of the concerns investors have had. Hi, I'm Richard St. Villas, writer for TheStreet.com. Tech stocks are one of my favorite areas to cover, so here's my 2 cents on the matter. Although Palo Alto has secured a double-digit market share position in the enterprise security space, Cisco has emerged as a worthwhile threat. Cisco's $2.7 billion acquisition for anti-hacking software SourceFire suggests that Cisco is going after Palo Alto's market position. But even with Cisco's size and scale, Palo Alto's capabilities are hard to trump. Palo Alto's next-generation technology have proven very efficient in protecting company networks from virus attacks, malware, and other security breaches. Its platform includes network firewall software and appliances. It also offers subscription services for threat detection and prevention, which has gained excellent traction within the enterprise. Investors also shouldn't discount that Palo Alto already generates an above-average free cash flow margin, which is not expected for a growth company. Remarkably, management has been able to achieve this with less than 15% market share. So although Cisco is indeed a worthwhile threat, Cisco should be just as fearful of Palo Alto. With the company due to report fiscal third quarter earnings Wednesday, investors would be wise to buy the stock before margin leverage sends the shares higher. On Wednesday, the street will be looking for 10 cents in earnings per share on revenue of $146 million. Earnings are expected to grow 66% year over year, while revenue is projected to grow 44%. Now, given the better than expected results released from other enterprise giants, analysts have grown more optimistic about Palo Alto's results. Last week, while affirming his outperform rating on the stock, Wells Fargo analyst Gray Powell noted that Palo Alto's full-year revenue growth projections of 37% may actually be too conservative. Unlike Cisco, which is by far a larger company, revenue has never been an issue for Palo Alto. In the February quarter, for instance, the company posted revenue of $141 million, which was up 46% year over year. The company posted a 31% jump in product revenue, while the higher margin services business grew at a 77% clip. On Wednesday, I don't expect much divergence from these numbers. Note, the recent data breach impacting retail giant Target underscores the importance of enterprise security. Companies are now on high alert, especially since more applications are being accessed from the cloud. No company stands to benefit more from this improved spending environment than Palo Alto Networks. Although the patent litigation trial with Juniper Networks does present some risk, I don't believe this threatens Palo Alto's long-term profitability, and the company's hybrid software and hardware model makes it a likely acquisition target for a company like IBM that is looking to diversify its business into a software delivery platform. So, with Palo Alto stock still down 17% from their all-time high, I would be a buyer here ahead of Wednesday's results. I project fair value to reach $90 on the basis of long-term double-digit revenue growth and free cash flow growth.